Artificial intelligence has been a hot topic ever since OpenAI came into the spotlight. These days, I would see almost every company racing to implement some form of AI into their products and services. And one exciting application or use of AI can be seen in utility companies. With AI, utility companies can predict energy demand, optimize grid performance, detect outages in real time, and even support the transition to renewable energy. So it's all about sustainability, reliability, and providing better service to millions of people while effectively and efficiently using our limited resources. Makes sense, right? And of course, more efficient operations and resource management means better margins, more profits, and further growth. All of the things that I like to see in my investments. So today, we're going to look at the top 3 AI-powered utility companies and see if they deserve a spot in your portfolio. But before we get into the details, I wanted to give a shout out to the Motley Fool for sponsoring this video. The Motley Fool provides investing insight and stock recommendations for investors of all skill sets and risk levels. So I'm excited to partner with the Motley Fool to bring you 10 stock picks from their stock advisor. The average stock pick inside Stock Advisor is up 863% versus 173% for the S&P. And you can scan this QR code or check the link in the description to get your 10 stock picks right now. Also, just remember that I am not a financial advisor and everything we discuss here is for informational purposes only. So, what exactly is an AI-powered utility stock? Well, it's water, energy, gas, or infrastructure company that uses AI to improve its services. And I'm talking about predictive maintenance, smart grid optimization, real-time outage detection, and energy forecasting. These companies are keeping essential resources flowing to our homes, and they're using AI to make it smarter, faster, and more efficient. Now, I keep a bunch of watch lists for different stock types, so I'm going to start with my AI-powered utility watch list. Then I'm going to add in analyst coverage, analyst ratings, and beta to screen them for the best ones. Now, if you're already familiar with these metrics, feel free to jump ahead to the results. If not, stick around because I bet you're going to learn something new and you can use this process for doing your own stock screens, not just for utility companies. So here's the criteria for my selection. First, I'm going to start with analyst ratings. Analysts are the professionals who follow different companies to rate, well, whether they're good investment. Analyst scores will range from a 1 to a 5, or for a better translation, from a strong sell to a strong buy. For this analysis, I'm going to screen for moderate and strong buy rated companies. Next, I'm also going to consider analyst coverage, or how many analysts are watching the stock. And this is a statistical preference of mine because the more data points that point to the same conclusion make me more confident in the potential results. I mean, let's look at it this way, right? If one person tells you that it's raining outside, you may be convinced, but you might peek through the window before taking out your umbrella and going outside. But what if 12 people all told you the same thing and they're all dripping wet? Well, if that's the case, you're definitely going to be bringing your umbrella before going out. No questions asked, right? So for that purpose today, I'm going to limit the results to companies that are covered by at least 12 analysts. And last but not least, I'm going to add in something called the 60-month beta. Now, if you're not familiar with beta, I don't blame you. Beta tells us the relationship between a stock's price movement and a larger index, like the S&P 500. And we can use it as a way to measure volatility. So let's say a stock has a 1.5 beta. Well, that means that for every dollar that the S&P 500 moves, the stock is expected to move by $1.50. And if the beta is 0.7, that means that you'd expect the stock to move 70 cents for every dollar that the index moves. The lower the beta, the less volatile the stock, and vice versa. The 60-month part just means the stock's prices from the previous 60 months are taken into consideration. It's just that easy. Now, beta is also a double-edged sword. I mean, high beta stocks may sound like a good idea in principle, but remember, the price movement prediction goes both ways. If the S&P moves down, then the stock will likely move even further down. So for this analysis, I'm going to limit the search to stocks with a beta of 0.5 to 1, which will give us companies that are less volatile than the index. By the way, I'm doing all this research on bar chart. I use their stock screener to research stocks every single day, whether it's for making videos, writing articles, or just for my own personal portfolio. And their website gives you all the basics for free. All you need to do is create an account using this QR code. Okay, so I'm going to hit see results, and here I've got 13 companies that come up on the list. Now, I'm not going to bore you and discuss every single one of them, so I'm going to take the top 3 here based on the highest ratings. And then I'm going to break down each company for you to consider. So without further ado, let's start with number 1 on the list, and this is a company called NiSource. NiSource is one of the largest regulated utility companies in the United States. It provides natural gas and electric services to customers in the East and the Midwest. The company services roughly 4 million customers across 6 states. So, if you're one of their customers, you might know the company through its Columbia Gas and NIPSCO brands, and it can trace its roots all the way back to 1847. Today, the company is successfully leveraging AI to improve customer service through its digital interface and chatbots, and it has also improved customer call handling times, collections, and more. From an operational point of view, it can also use AI to identify vegetation that can potentially affect power lines, as well as conduct routine sweeps for preventative maintenance and safety. The stock has a strong buy rating and a 0.5 60-month beta. But the cherry on top is that the company pays dividends and has increased them since 2013. Today, the stock has around a 2.7% dividend yield. Next up is Constellation Energy, the largest producer of green energy in the States, generating approximately 10% of the nation's clean power, 90% of which is carbon-free. The company operates a fleet of nuclear, hydro, wind, and solar generation assets to service commercial, industrial, and residential customers nationwide. Constellation is also using AI and machine learning to modernize its operations, optimize grid performance, manage energy demand, and improve demand forecasting. The company partnered with Blue Wave AI Labs to manage its nuclear assets, while Pair.ai handles customer data management. The stock has a moderate buy rating from analysts and a 0.85 60-month beta, and has a dividend yield around 0.6%. Now, here's a question I've encountered on my Discord server. If the potential upside based on the high target price is low, do you buy the stock? Well, the answer usually is it depends. In this case, Constellation is a premier clean energy provider, which could make it a potentially attractive long-term investment. Besides, analysts update their estimates frequently, and their target prices are based on the next 12 months only, so things can change as time goes on. Last but not least is Entergy Corp, and this is an integrated energy company servicing approximately 3 million business and residential customers across Arkansas, Louisiana, Mississippi, and Texas. Like many energy companies, Entergy has made significant investments in clean energy generation through solar and hydroelectric power plants. Speaking of investments, Entergy is now using AI to improve service quality for its customers. Their platform aims to reduce the frequency and duration of power outages, making energy delivery more reliable. Its more advanced metering features also provide direct data and insights to better predict power demands. The stock has a moderate buy rating, a 0.68 60-month beta, and a 2.7% dividend yield based on the stock's current trading price, which could make it a good long-term investment bet to ride out market volatility. AI-powered energy stocks offer the potential to capitalize on how artificial intelligence is changing the game in the energy industry. With better outage prevention, improved customer service, and smarter grid management, these three already giant companies have what it takes to fuel their growth for years ahead. Still, remember that when it comes to buying stocks, due diligence is always required. My videos can be a great starting point for research, but it's always best to chat with a financial advisor. And what are your thoughts about these three AI-powered energy stocks? Are any of these companies on your radar? Let me know in the comments below because I'd love to hear from you. And of course, if you happen to find this video helpful, don't forget to like and subscribe. Thank you so much for watching, and I'll see you in the next video.